Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update, and I'm going to focus mostly on the debt ceiling and how that's going to impact the markets and investments, so you have an idea of what's going on and how that might affect us. So first I want to talk about exactly what the debt ceiling is and kind of how this came about. And so this actually goes back to how Congress and the Treasury kind of operate the government. And so the Congress authorizes all these different spending. This is the things that we want to spend money on. And it's up to the Treasury to figure out how to pay for it. So they put out all these Treasury bills and Treasury notes and all these things, and they put out these different denominations and different terms, and this is how they generate the funds. Well, at the end of the day, we ran out of money back in January. So we couldn't issue any new treasuries, and this is due to a self-imposed ceiling on the amount of debt that the United States can carry. And so this is debt that the Congress actually sets. And the reason that they set this debt is to make sure that we don't run up too big of debts and deficits for the country. And this has been around for a very long time. And so when this debt limit was hit back in January, we didn't immediately default because the government, the Treasury, actually has a bunch of cash that they use. It's kind of like, think of it like a checking account. And that thing is kept at about $500 billion, about $500 billion. And so they've been spending that money to fund the government for about the last 6 months. So what's happened is we're getting to the point where we're about to run out of that money. So come June sometime, they're thinking middle June, something like that, they're going to run out of funds. And at that point, we're going to need to do something, either take out more debt or cut government spending. Of course, the objective is to take on more debt. This is what the government is planning on doing. And so this whole debt ceiling debate is basically Congress authorizing the government to take on more debt. And it's kind of a big charade. It's a big show. It doesn't mean a whole lot. At the end of the day, the Republicans are pretending like they're doing something. They're asking the government to cut spending back to what spending was 6 months ago. So this isn't like this huge spending cut. It's really kind of just a way for the Republicans to pretend like they're doing something to cut spending. And of course, the Democrats want to retain all the power and that they're in control, and they don't want to give any power to the Republicans. So they're saying we won't even allow this minimal amount of spending cuts. So at the end of the day, think of the government's treasury as like a checking account with $500 billion in it. Well, that's gone all the way down. So we have to either get a new credit card or we have to cut government spending. And it's not that difficult. The government doesn't really have to default. They just have to cut some government spending. Only about 13% of the government is the revenue coming in pays interest on the debt. So it wouldn't be that difficult for the government to figure out how to continue to fund the government, but we would have to cut back on some government expenses. Well, the government doesn't like to cut back on government expenses. They want more government, and so this is where the problem comes up. But where the real problem is, this whole debt ceiling debate and everything, I think it's really silly. Whether we have a technical default or they extend the debt, we know they're going to extend the debt at some point. So whether this takes 2 weeks or 3 weeks or whatever, this is all irrelevant. It means nothing. I know it has affected a lot of the financial markets, and this is a temporary, and it can create problems. Right? When you look at the financial markets, let's say you have a fund that has a bunch of money market accounts, they're all backed by treasuries, and people want their money back, and all those treasuries are no longer paying, they're in default. Well, those money market funds might have to say, well, we can't give you your money back. We got to wait 2 weeks until this whole thing is resolved. So it does cause problems if there's some kind of leverage on treasuries as the collateral for the loans. That's a potential problem. Sorry, we can't pay until these are resolved. So it does create some issues, but at the end of the day, that's minor compared to what I see coming. And this is what no one's talking about, and this is where you have to really be kind of looking beyond that. I know that eventually this debt ceiling debate is going to get resolved, and of course the government's going to do what they always do, which is increase the debt limit and allow for more government spending. The problem that I see is the Federal Reserve has been doing what's called QT, or quantitative tightening, for pretty much this whole year, and even at the end of last year. They started this quantitative tightening actually the beginning of 2022. But what's happened is during this time that the Federal Reserve was doing all this tightening for 2022, you saw a real drop in asset prices. So the stock market really dropped in 2022 that corresponded with this tightening. And so the S&P was down over 20%. And right about the time that the government ran out of the ability to issue additional treasury notes and bills, what happened is they started spending down all of this cash that they had at the Treasury, and that kind of kept the liquidity within the markets equal, because the amount of money that the Federal Reserve was removing from the market, the amount of liquidity the Fed was removing, was being added by the Treasury over the last 6 months, so it's kind of a wash. And this is when the stock market's kind of stabilized, all the asset prices stabilized, and we've even seen a big jump recently in some of the big tech companies. And so the stock market actually is down this year if you remove some of those large tech companies. If you look at just Microsoft and Google and Nvidia and some of these big tech names, they're way up this year. And of course everyone's, these are way up, we should be invested in these. Well, they're still down because they dropped so much in 2022. They haven't even recovered what they lost in 2022. So these tech companies, I think, are a real bubble again. But here's the problem. If we have a debt ceiling resolution, what's going to happen is all of the money that the Federal Reserve is taking out of the system, well, now the Treasury is also going to be taking a bunch of liquidity out of the system, because what they're going to be doing is trying to replenish that $500 billion reserve. And so this is a double tightening. This is going to create, the liquidity is going to be a problem, and it's going to create a real problem for asset prices the back half of this year. So I do see a real negative for the stock markets, for asset prices, and we got to be careful. We got to position all of our accounts the right way to make sure that we're putting ourselves in the right position. Now, I do think that this could potentially cause even a worse recession. And if this happens, I believe the Federal Reserve is going to stop quantitative tightening and probably even go to quantitative easing. Now, that's a completely different thing. When that happens, that's when you're going to see a lot of the inflation investments, gold, all that stuff just skyrocket up. We're going to get huge returns on that. But temporarily, we got to hedge and protect our accounts. And there's no way to predict exactly when this is going to happen, because the Fed's going to pivot whenever they're going to do that. And we can't predict. It's all political when it's going to happen. But we just have to understand that right now we want to continue the same thing that we're in, the protected accounts, high quality value stocks. The buffered index is a great investment right now. We actually have the new term on the new one we have. You can make up to 25% return over the next 2 years with a 20% dual directional buffered index. I mean, that's a fantastic term. We still have the multi-year guarantee products where you can get 5% a year every year for the next 3 years. So the MIGA. Those are great products. It allows us to kind of protect what you have. So we're going to be in a little bit more defensive mode here, kind of temporarily, probably through the summer. But there will be, I think, an opportunity to see some big returns out of some of the accounts that are in, precious metals and energy and agriculture when inflation spikes back up. And I just don't think the Federal Reserve is going to continue tightening while the Treasury is also trying to build their reserve back up. It's going to be a real problem for asset prices. So we're watching what's going on, and we're positioning all the accounts the right way. If you have any questions, feel free to give us a call. We'll be happy to go over these with you. But we are watching the markets very carefully and making sure we're positioned right. I will, just as a side note, talk a little bit about what we're dealing with here in the office, and this is a perfect example of kind of the inefficiency and what we're dealing with regulation and things within the government. We just got a new compliance rule that we have to follow now as an investment advisor. So every time we move an investment within an IRA or any kind of qualified account, so 401k, IRA, these kind of accounts, we actually have now a paper form that we have to handwrite, that we have to say why we're moving it from one investment to another investment. And so we have to complete this whole form. Every time we make a change in an investment account, we got to do this form, and this is a new compliance requirement. And this is unbelievable. Every time that a change is made, you got to complete this whole form. And I mean, what do you do with them? Oh, you just store them. You know, we're not going to look at them, anything. You just have to have them stored here, you know, in case you get audited, you know, you got to come in, we got to be able to see these forms. So this is a huge regulation burden for every time a transaction. I mean, this is unbelievable. So you just can't make a change to someone's investment account. You have to document everything on here. There's all these different questions and document to do it. So this kind of inefficiency and bureaucracy is what we're dealing with across the board. And so, you know, what do you do with all these papers? You got to store them somewhere. Now you got to have someone that keeps track of this. We got to make sure that's all done right. Well, now there's going to be an auditor that has to come in when the government's going to have to pay that auditor's salary. And then, of course, that auditor needs a supervisor to make sure they're actually doing the auditing. And then, of course, we got to pay for their health care and their pensions, the whole bit. This is why you're seeing all this. And it's throughout the whole economy. One of my clients, they're actually selling their house here in San Diego, and they're buying a cheaper house up in the Temecula, Murrieta area. And the reason is their child actually moved up there. They have some grandkids now, so they want to be closer to the grandkids. And so they sold their house here for a larger amount, bought a cheaper house for cash up there, and they were able to take some of the excess money and invest it to create more retirement income. But one of the things that they're dealing with is they're buying a brand new house up there, and unfortunately you cannot have a gas stove in a brand new house now with some of the new California rules and regulations. So this is crazy. They're buying this house, and of course the wife, she really wants a gas stove. She doesn't like cooking on electric. So after they buy this brand new home, they're going to tear up all the walls and all this stuff to run a gas line all the way into the kitchen, which isn't going to be there right now because it's all electric oven, electric stove. So they got to run this whole gas line and then buy and rip out the electric stove and put in a gas stove. So at the end of the day, then they're willing to do this. So I'm thinking to myself, how many other people are willing to do this? And the amount of inefficiency this is, I mean, if the builder could have just put a gas stove in right from the get-go, then they could have run the gas lines when everything was open and it would have been all great and fine. But now all this extra cost is associated with having to tear all this stuff out and put it in a brand new home. So this is the kind of inefficiency. And we're seeing this across the board in multiple things. You know, for example, there's a little shower that I'm putting in out next to the pool, and this shower is maybe going to be used 5 times a year. I mean, this is a shower by the pool. It's got a little thing to wash your feet and, you know, take a shower outdoors, and you know, it's not going to be used much. But the shower that I really wanted, which is a nice outdoor shower, high quality, it's got the little foot thing, the whole bit. I tried to buy it online, and it said I can't buy it because I'm in California. And so apparently this thing puts out like 3.7 gallons, and the California maximum is 3.3 gallons a minute, or whatever the rules are. But I mean, this is craziness. So ultimately, anyone who deals with this, what they're going to ultimately do, most likely, is they're going to have this product shipped to a relative in another state, and then that relative is going to end up shipping it here. So we're going to, you know, so this person would put it in the shower anyway, and now it's got to go through this whole process. So you're wasting gas and energy and everything, shipping this thing all over the place. And so, you know, a new recent one is the dishwashers, right? So this is new Biden regulations are going in here. So this is going to affect new dishwashers in the future that are being manufactured. And so in a few years, all the dishwashers have to use 30% less water. Well, you know, ultimately, the government doesn't understand this, the consequences of doing this. What ends up happening is someone maybe, now their dishes don't get clean after one wash because it's only 70% of the water, so they run their dishes through 2 washes, right? So now you have to do 2 washes to get your dishes clean, that used to just take 1 wash. So the government says, oh, well, now it's only 70% per wash, but now they're doing 2 washes, so now it's 140%. Now you're actually using more water because you got to wash twice. So these are the kind of inefficiencies that we're seeing, and this is happening throughout the economy, from air conditioners to light bulbs to all these different things. And so this is all very inflationary. It's going to harm the economy. This is the kind of stuff we're dealing with at this point. A lot of companies are facing a lot of red tape and regulations. So at the end of the day, go out and buy a new dishwasher if yours is getting old before the new rules go in. But these are the kind of things companies are dealing with. So at some point, this kind of stuff usually gets turned around. So it's just the current administration is putting all these rules and regulations and the whole bit, and they're trying to, do good, right? They're trying to say, okay, we're going to do these things, we're going to protect the environment, we're going to use less water, this and that, but it's unintended consequences. They don't understand what the result of that is. And so at some point when this red tape gets cut and the economy is allowed to expand at some point, I'm sure that sometime in the future we'll turn around. But in the meanwhile, let's just prepare for tough times, more recession. We want to make sure that the accounts are protected. So we're really looking at it from a defensive standpoint. So if you have any questions, feel free to call the office. Happy to chat with you about your accounts. And if you're not a client, you'd like to learn more about what we do, just give us a call. We'll be happy to put together a financial plan that tells you exactly what you should be doing right now with the current market environment. And one last thing, we are focused heavily on tax reduction, and we got some really neat stuff coming. We've got some great Roth conversion investments that are coming. I can't talk about them or mention them quite yet because they're not through compliance yet. But in June, we will have some really good stuff. So if you're interested in Roth conversion, getting money from IRAs to Roth IRAs at a tax-advantaged strategy, just give us a call and we'll be happy to put you on the list, make sure you understand what some of these new investments are and how you can take advantage of it. So thank you all for watching. I hope that was a good market update. I know it was a long one, but there's a lot I wanted to cover today. So thank you all for watching. I hope to see you in our Mission Valley office very soon.